Welcome back, everyone. And today we're going to talk about interesting topics, as always. So we could talk about how to use your equity and how to use your wealth, especially in high-cost markets, to create realistic wealth. Welcome, Julie.
Good morning, Sam. How are you?
Fine, thank you. So before we begin to share this video, look, I live in the San Francisco Bay Area for the past 30 years, and you know how expensive the Bay Area is. And also,
Very.
Julie, you live in Southern California all your
Mhm.
life, LA area. And
Yep.
likewise,
Very expensive.
so with that said, so let me just go through our topic. Okay. Good friend, Tony Bruno from the Bay Area, a realtor. He's been a realtor for close to 40 years
Hmm.
in the Bay Area. He sells local homes in the Bay Area. And I'm going to show you two homes, recent listings he has. He's kind enough to provide me this data from time to time, Mr. Tony. These two houses are located in Fremont, California. I used to live in Fremont for 25 years, but I moved into the suburbs of the Bay Area, no longer
Okay.
Fremont. But so obviously my children grew up there and everything else. Fremont, again, like 20 miles northeast of San Jose and across the bay from San Francisco. Okay, quickly, let's go over these two listings. This home,
Mhm.
a cookie cutter entry level home built in 1950.
Right.
Right here, it was recently, a few weeks ago, was selling for 1.7 million.
Oh
And
my goodness.
the square footage is 1,832.
Wow.
We're talking $1,000 per square foot, right?
Yeah, man. It's incredible.
Yeah. It was sold very quickly. I'm not sure whether it's all cash or not. Oh, actually, it was listed at 1.749.
Oh my goodness. It closed at 1.970.
That's right.
Bidding war.
There was a mini bidding war, like three, four,
Mhm.
five offers per house. So yeah, mini bidding war. Okay, let me show you another.
Wow.
Yeah, let me show you another property. Mind-boggling. This area, when we live in Fremont for years, we were in a better neighborhood. This
Mhm.
neighborhood right here is located in central Fremont. Very old homes. If you put these homes somewhere in Kentucky, 1,400 square foot, built 80 years ago in Kentucky, Indiana, or Detroit,
Sure.
it's going to sell for $100,000.
I was thinking 100,000.
Although we enjoy living in Fremont, it's nothing special. It's a cookie cutter middle class neighborhood selling for 1.5 million.
Million and a half. Wow.
Yeah, this home is 1,100 square foot.
That's very small. Apartment size small.
You have not heard the end of it. It was listed at 1.45. The final sales price is 1.9.
Oh my goodness. Unbelievable.
1.9 on this cookie cutter regular track home. Well, I've been living there in Fremont for a long time. And this neighborhood is okay. It's a middle class neighborhood. The school district's not bad, like most Bay Area. But personally, if I had $1.9 million, I would not pay for this house.
No, I agree. It's unbelievable.
We're not here to talk about why people buy these kind of houses in Bay Area. No, it's a Silicon Valley, right? Bay Area is a Silicon Valley. People have
That's
money.
true.
People buying this house probably for cash, 1.9 million. They probably have their rich parents maybe give them $500,000 of cash. They got some stock options from their high tech company, whatever, right? Very high end, high tech professionals that make six-figure income. They can afford
Right.
$1.9 million.
Okay.
And 30% of the time, they pay all cash. High tech professionals want to buy a primary home. They have young children. They like the school district. They don't care about the size of the home. But I wouldn't pay $1.9 million, knowing
Yeah.
what I know.
Yeah, that's a lot. That's an incredible amount of money for such a small house in such a regular neighborhood.
Yeah, same scenario in your area, certain neighborhood, same county or Southern California,
Mhm.
same situation, right? People,
Uh-huh. Mhm.
it's crazy. The level of money people pay just to get a cookie cutter mid-century home, nothing to brag about. You know what's my point? My point is, if I were a California homeowner or an investor, I would do three things. I would do a 1031 tax-deferred exchange.
Oh,
I would,
okay.
I would cash out refinance the equity from the California home. I would do a home equity line of credit.
Those are deep strategies.
Yeah. So look, the thing
Mhm.
is, Julie, is that, yeah. So the thing is, many homeowners, they lock in at a mortgage rate of 4%, 3%. That's fine on your first loan. Keep your historical loan rate. But the excess value you have in your home, if you are an investor, why not? Why not catch up refinance or take out a home home equity line of credit. 200,
Okay.
300K, 400K home equity line of credit. And or do a 1030 or sell your home in California, a $1.5 million, $2 million home, cookie cutter home, $2 million home, and do a 1031 or use line of credit to buy 5 or 10 out of state properties
There you go.
in various locations.
That
Right?
makes sense. Yes. Mm-hmm.
Do leverage 20% down, borrow the 80%. Buy in good
Yeah.
markets, cash flow markets. Stay away a rental property in California that is probably not going to cash flow that much at all. You have a whole bunch of equity. Do a 1031, exchange 1 to 10, 1 to 5, 1 to 10, 1 to 15 ratio,
Makes sense.
and
Mm-hmm.
not paying capital gains tax on the selling
Right.
house. Julie, over the years, I have done several of this 1031 tax-deferred exchange for my
Wow.
California investor. Well, tons of equity in the California home, cash flow, the numbers does not make sense. Very low. They're able to buy 5 or 10 out-of-state properties in Florida, Texas, Alabama.
That's a good point. You're not going to get the cash flow here. You would in state. Why not do the 1031 exchange and buy quadruple the properties and have more income coming in?
That's really, and the old past 20 years, that's what I've done for our investors from California. And
Right.
not only California, right? You could be living in the Pacific Northwest, Seattle, high cost market,
Very high.
live in New England, Northeast, Washington, D.C., Northern Virginia, and New York City and Connecticut, where the home prices are very expensive in those areas as well. You have a lot of equity. There are 30 trillion dollars of wealth of equity
Wow.
only in the U.S. Highest
Amazing.
equity position in history of mankind. So you cannot sit on your debt equity, not doing anything about it.
Right. Right.
You can unleash some of your equity. If it is a primary home, you keep your low mortgage rate. A home equity line of credit, $2 grand, and buy multiple properties out of state. You can retire in a few years and be able to buy 5, 10 properties.
That makes sense.
I like the scenario we work with, Julie. Our risk investors, we have several thousand members within my network with investors.
Right.
They have purchased out of state rental property from California and a few other areas. Investors working with us purchased rental properties 3 or 4 years ago in Austin, Tampa, Cape Coral, Florida, other areas of Texas, Raleigh, Charlotte, and a few other areas. They bought it for like 4 years ago for like 150,000 in this area. Well, in those areas, like 200K.
Right.
Because of the housing boom, their 200K homes have increased to $350,000. Almost 50 to 100% increase in appreciation in
Right.
the past 3 to 4 years in those rental properties.
Amazing. That's unbelievable.
And they took out a 25% loan. Those properties
Sure.
cash them very well. They're doing very well. Let me give you the strategy, those investors. Let's assume because they increased their equity so much and they got an existing loan at 20% down, now their LTV, loan to value ratio, right? Okay, we don't have no time to explain LTV. It's a loan to value ratio like 50 to 60% LTV, loan to value. Let me give you an example. I just gave you 200 grand, they purchase price.
Yeah.
Now
Right.
350K. So the loan was 150, 100,
Right.
which is 20% down.
Sure.
$150,000 loan balance and the value of the home is 350.
So you get 200,000 in equity.
They are, even though the investment loan that was 4% interest rate, fine.
Right.
But you have to understand, as an investor, you don't have to keep this loan forever. Some investors are very conservative. They don't want to keep this rental house and long term, and they can increase the cash flow so they can retire off the cash flow from the homes and never do anything to the home. Just keep it, which is
Right.
fine. If you're close to retirement, you could keep this rental property and live off the rental income
Makes sense.
with a 4% interest rate, which is fine. But what if your goals are 10, 20 years down the road? You're not ready to retire. You need to build by
Sure.
properties. You need to use the equity to do a tax-free cash out refinance for your rental properties. Even at 4%, it does not matter. As a primary home, if you own a primary home, I understand if you want to never do anything on your 3% mortgage
Of course.
or 2.5% 30-year fixed rate mortgage on a primary home. I get it.
Right.
You don't want to do anything to it on
Right.
existing loan, right? But on a rental property, if you're very ambitious, if you're very aggressive, if you want to accelerate retirement in the next 10 to 20 years, it's okay to cash out refinance that rental property and get rid of the 4% mortgage rate, because you're using the
Right.
equity leverage into more rental property for 10, 15 years now, right?
Absolutely. 100%.
Even after cash out refinance, even at a 7% interest rate, you have a new loan on a rental property, a new mortgage payment. You may not cash flow that much anymore, right? You got rid of the 4% investment loan. You replace that with 7% loan, but you have to pay back the new loan.
Sure.
You may not cash flow much on the rental property to refinance. You may even have a negative cash flow when it's all said and done, and when the dust is settled, right? But if you're able to use the $150,000 or $100,000 equity to buy 2 more rental properties, that's how you scale. That's how you leverage into more wealth down the road.
Absolutely. That makes sense.
Do the math. Consult with your agent. Consult your local agent and crush the numbers. Make sure all the numbers jive. But also make sure the next property you're going to buy, make sure it's a good rental property, good cash flow, good market, right?
Absolutely.
What are your thoughts? Do a line of credit from your primary home, leave the low mortgage rate alone from primary home, cash out refinance the rental property that you to buy more property.
Right. The second scenario about cashing out. Yeah, because I've always been cautious about putting anything against your primary home. If you have another rental where you can cash out and refinance, I think that's a great viable strategy. It's all investment property and how you manage it to get the best numbers depending on your goal.
I agree. So with that in mind, let me go a step further, right? Let's go through some of the possible properties you buy. You can buy a property in Oklahoma for $150,000, rent for $100. You meet the 1% rule. You have a positive cash flow right here. So a quick example, we're not gonna go over for the you can buy a duplex, brand new duplex in Oklahoma for $320K. It rents for $2,600 in both doors. You have a
Very nice.
Even with a higher interest rate, 6 to 7%, you still cash flow a whopping $624.
Right.
When it's all said and done. So this mind-boggling. Even at today's housing market, as an investor, there's so much opportunities to buy low-cost cash flow properties in the best location in the country.
That's a great deal. That's a great deal. A duplex, new construction? Oh, yeah. Can't beat that.
In Central Florida, this is amazing. Another new construction in Ocala, one of the fastest growing area in the country, Ocala, Florida, which I have been there myself. The price is right here, $264,000, brand new.
Nice.
Rent for $1,695 and a cash flow for almost $300. You get the builder's rate buy down, increase your cash flow, 4.99% interest rate, no property management fee for 2 years, and the seller will pay some of your closing costs. Amazing incentive. Fast growing area in South Texas, brand new fourplex for only $545K, cash flow for $773, which is amazing numbers.
That's unheard of.
Those are just a sample, okay? Some brand new fourplex in Florida. So all these great areas. By the way, these kind of Florida homes, the insurance rates are reasonable because they are inland.
$61 a month? That's cheaper than some of my properties in upstate New York.
Exactly. Where's it?
Property tax insurance.
$61 a month, $728 the insurance premium for the year on this rental property in brand new construction in Central Florida.
Wow.
Some people are misinformed. They think, the insurance rate is $728 per month. Some people are being misinformed by all this sensationalism reporting about the demise of Florida as a result of a hurricane. Yes.
Right.
Yeah, in some areas, coastal areas, yes, insurance premiums are very high, but we are not talking about coastal areas. We're talking about inland areas where amazing opportunities are still occurring. So,
that's great.
So, what's your takeaway from this video presentation, Julie?
There's a lot of opportunity out there for people to take advantage of deals. Encourage your followers to do their homework, do their research, get with someone that understands what their goal is and be able to create a strategy that works best for them. if they own their own home or if they have rentals and they want to do, like we talked about earlier, the 1031 exchange or a cash out refinance. Those are all great strategies, but they're not all great strategies for everybody. So you have to find what's going to work for you. So get some people under you, or surround yourself rather with some people that can really give you some wise counsel and make the most, because there's a lot of opportunity out there. People don't realize that. They think, I have my one rental and I'll stick with that. You've had it for 10 years. There's probably a lot of equity in it now. You can do some other things with it.
Wow, Julie, you learned so much over the past few years. Being part of my network, you're
Yes.
an investor. Everything you said is correct. There's nothing more I need to say. Yeah, investment opportunities is out there regardless of what's happening with the economy or with the mortgage rates or recession this, inflation that, the doom and gloom, the elections. Focus on your personal economy. As an investor, the world is yours.
Yeah, absolutely. I agree. And it doesn't matter which political office is in party. This time next week, we'll know.
We invest in boring investment.
Boring is the word. Yes.
Being consistent, invest, get your cash flow, appreciation, long term, take advantage of the tax benefits, and the tenant can pay all your debt for you. And you can pay down your loan, invest for 5 or 10 years, overcome all the adversities, and achieve your financial goals. Thank you, Julie. If you see value, please like and subscribe to our YouTube
Yes.
channel, and also put your email into our website below you in the description, so you can become a free member of our real estate investing community, so you can receive free email into your email inbox every morning to talk about real estate investing, talk about housing market, economy, the whole 9 yards. Thank you so much,
Yes.
Julie.